I think the Fed is exactly where it should be. If you go back to pre-December 24th, they're actually explaining that they were seeing slowing economic growth. And the stock market reacted to basically the Fed being your friend and having the Fed put in place. I think that essentially the issue is the Fed is seeing slowing growth. They're seeing uncertainty in trade policy. And effectively, they in fact eased by stopping to raise interest rates. I don't think that they're done. I think they've done exactly the right thing. And now we have dislocation between stock prices moving higher and economic growth slowing. Usually it works simultaneously that economic growth would lead to lower stock prices.
Rick, it's interesting to see where the 10-year, for example, sits today compared to at the start of the year. It's pretty much not moved, whereas equity markets have rallied significantly. And the main reason we put down to that rally for equity markets is a pivot from the Fed, and yet interest rates haven't really shifted quite as much.
Yes, thank Europe, thank Japan, thank China. The rest of the world is having a very large effect on our sovereign debt market, no doubt. And you're exactly right. We're only a handful, about 9 basis points away from trading at a yield, 9 lower, that we haven't seen since the early part of 2018, over a year ago. So you're exactly right. You know, here's the Dow Jones Industrial Average, really within 3 sessions striking distance of all-time highs. And I think this is a quandary. And when you think about that dynamic, Wilf, it's more than enough of a foundation to build a pause on. You know, everybody's so worried about the pause, what it means. Will the next move be a tightening? Will the next move be an ease? Who knows? The balance sheet, okay, they stop this year, they stop next year. Nobody can tell you the real effects of what these central banks have done with bloated balance sheets or the effects it's going to have in the grand scheme of things if they shrink them a bit. We don't want balance sheet and quantitative easing to be a first, second, or third tool in any central banker's toolbox. But at the end of the day, rates being a bit spongy is a reason for concern about growth. And trying to divine how lack of growth in Europe, how much of an effect it's having on our sovereign debt market, skewing the relationship you just pointed to, will be integral for investors. Because at some point, if we start trading under the 13-month low of 255 on a closing basis from the second day of January this year, you're going to see interest rates drop 15, 20 basis points, probably fairly quick in the U.S.